Welcome to this explainer. If you've just been casually skimming the headlines this week, you might genuinely think you're looking at a bunch of random, scattered updates from the tech and auto worlds. But if you pull back just a little bit, a completely different, deeply connected story emerges. The Autonomy story literally stopped being this maybe someday futuristic promise this week and officially started operating as a real, tangible business.
The reality is, if you only looked at car deliveries over the last few days, you completely missed the actual narrative. The biggest pools of money on Earth are right now actively repricing around the reality of autonomous driving. We're shifting away from a narrative of what if directly into what now. And honestly, the financial implications are staggering. We're talking about a fundamental, ground-up shift in how this entire industry operates, how it values itself, and how it's going to scale.
Okay, let's dive right into this. Here is our roadmap for today. We'll be covering scaling the robotaxi, the insurance safety bet, pouring concrete for autonomy, the big AI tech race, and finally, Tesla's 3 value buckets.
Starting off with Section 1, scaling the robotaxi and expanding the product.
So, for years, autonomous rollouts have been this painfully slow, block-by-block crawl, right? Hand mapping every single intersection. But look at the sheer speed of this recent expansion. Down in Austin, Tesla just pushed its unsupervised robotaxi zone, meaning absolutely no safety driver in the seat, from a tiny sliver of the city to cover the entire metro area. We're talking suburbs, the airport, the whole shebang in under a year. Meanwhile, Estonia just became the third EU country to greenlight full self-driving, joining Lithuania and the Netherlands. And get this, over in Canada, enthusiasts just drove 3,760 miles straight from Vancouver to Halifax on FSD with 0 reported disengagements. They aren't hand-mapping new neighborhoods anymore. They're expanding a generalized driving system. It's like a giant puzzle where every new piece actually makes the rest easier to solve.
And that brings us to a massive, absolutely crucial number, 1.3 million. At the recent CVPR conference, Ashok Ellaswamy, he's the head of Tesla's autopilot and AI team, pointed out that 1.3 million vehicles globally already have the hardware to access FSD. They are literally just sitting there right now in driveways across places like Germany, the UK, Japan, and India, just waiting for the regulators to say yes. Since the hardware is already in the cars, turning it on is nothing but a software update. That represents an incredibly high-margin revenue stream. Every time a regulator signs off, a new, highly lucrative revenue valve just pops wide open.
Moving on to Section 2, the insurance safety bet and the actuary's move.
Now, this is where we transition from cool software demos to cold, hard financial proof. Let's be real, insurance actuaries are not exactly known for their wild tech optimism, right? So we have to ask ourselves, is autonomous driving actually safer, or is that just brilliant marketing? For years, this whole debate has been fought with cherry-picked statistics and carefully edited YouTube videos. But this week, we got an objective answer from the ultimate arbiters of risk, the people who have real, substantial money riding on getting the math exactly right.
Check out this perspective from Shai Wininger, the co-founder of the insurance company Lemonade. He says an insurance company exists to price risk accurately or goes broke. I mean, think about the weight of that. Insurance companies do not build products out of tech fandom. They build them based on hard crash data. If an insurance actuary is willing to bet their own company's bottom line that a piece of software is safer than a human, well, that carries infinitely more weight than any slide deck a tech CEO could ever put together.
Which leads us to this jaw-dropping number, 50%. Lemonade just brought its autonomous car insurance to Indiana. What they do is they plug directly into Tesla's Fleet API, so essentially a real-time data pipeline, to watch the car in real time. If you are driving on FSD, they charge you exactly 50% less for every single mile you drive compared to when you're physically steering the wheel yourself. Why? Because their pricing models show that FSD miles are literally twice as safe as human-driven miles. They are betting real premiums on that safety gap being a factual reality. And this brilliantly illustrates a clear tech flywheel. Walk through this mechanism with me. Step 1. The insurance is cheaper when you use FSD. Because it's cheaper, that obviously nudges you to use FSD more often. That increased usage feeds Tesla a massive influx of real-world driving data. Then, that mountain of data trains the next version of the software, making it even safer, which in turn justifies an even bigger insurance discount. It just compounds exponentially. This is exactly how exponential tech growth works out in the real world.
And importantly, this isn't just an isolated American thing. Over in China, BYD just became the first automaker globally to promise full damage coverage if you crash while using their Level 2 city driving assist, meaning systems where the driver still has to pay attention. They are literally absorbing the liability onto their own books to ensure customer comfort. Now, sure, their exact reasons might involve dealing with customer trust issues, but the macro signal is identical. Actuaries across the entire global industry are finally getting comfortable with the math behind assisted driving.
All right, Section 3, pouring concrete for autonomy, the physical build-out.
You know, it's incredibly easy to get distracted by software updates and profit margins, but real estate? Real estate tells you if a company actually means what they say. And we saw 3 major physical buildouts land this week. First, a stretched 6-seat Model Y L was spotted testing at the Fremont factory. This suggests a much-needed, high-volume family vehicle is on the way to the U.S. to fill out the fleet. Second, and maybe more importantly, Tesla is quietly rewriting city permits for a 51,000-square-foot facility in Grand Prairie, Texas. It's not just another service center. It's specifically designed to charge, clean, and maintain autonomous vehicles. It is a literal robo-taxi depot. Third, there's a massive $55 billion AI compute fab project called Terrafab being negotiated in Texas. This involves SpaceX, xAI, Intel, and Tesla as a customer. These aren't just concepts. These are the literal garages, family vehicles, and raw computing power required to run a global driverless fleet.
That takes us to Section 4, the big AI tech race, Tesla versus the industry.
To really grasp the scale of what's happening, we have to look at the macro environment. Tesla isn't operating in a vacuum here. They are in an all-out sprint against some of the deepest pockets in the history of capitalism. Notice the stark contrast in strategy. On one side, Waymo relies on bolting 13 cameras, 6 radars, and 4 LiDARs, which, by the way, are incredibly expensive laser scanners, onto a custom rebranded minivan imported from China, and they rely on incredibly expensive block-by-block mapping. On the exact opposite side, you have Tesla using a mass-produced Model Y, relying exclusively on an in-house, camera-only stack activated by a simple software switch. One bet relies on expensive hardware to brute force a city, the other bets on scaling cheap software and existing mass production. If Tesla's camera-only approach keeps proving safer, their cost per robotaxi will be a tiny fraction of Waymo's.
And just look at the sheer volume of capital moving around this space right now. Just this week, Anthropic raised $65 billion at a massive valuation. And fascinatingly, they're actually renting compute power from Elon Musk's own Memphis data center. Meanwhile, Google just sold $80 billion of stock, primarily to buy NVIDIA chips. And NVIDIA itself launched the RTX Spark to own the consumer AI stack. The rest of the tech world is raising $250 billion just for compute power. Against that massive backdrop, Tesla's decision to quietly fabricate its own custom-built AI-Fi and Dojo processors highlights a very distinct alternative strategy, bypassing that crowded NVIDIA waitlist entirely.
Section 5. Tesla's 3 value buckets. Reframing the stock.
So, if you follow financial news, you hear a lot of noise about interest rates and quarterly car deliveries, but based on what we've just covered, we really need to reframe our mental model of this company into 3 distinct buckets. Bucket 1 is near-term cars. This is the deliveries, the margins, the price cuts. It's cyclical, it's under pressure right now, and frankly, it's almost exclusively what traditional Wall Street fixates on. Bucket 2 is middle FSD and Robotaxi. This is pure software margin that scales infinitely across global metros. You write the code once, you sell it 1,000,000 times. Then Bucket 3 is long AI and robotics. We're talking the proprietary AI processors, the Optimus robot, and massive compute rentals. So the crucial takeaway here is this. Wall Street spent the entire week stressing over Bucket 1, but almost every single piece of major industry-shifting news we just covered happened in Buckets 2 and 3.
Which leaves us with this final thought. We have watched autonomy evolve from an always 2 years away promise into an actively funded, highly insured, mathematically proven reality that is operating right now in major metro areas. The regulators are starting to sign off, the actuaries are betting their own money, and $250 billion is pouring into the underlying compute. So I leave you with this question. If the autonomy economy just permanently turned on, are you really still only going to watch the car sales?